Is your advisor setting you up for failure within retirement? Even if they're a good advisor that otherwise has your best interest at heart, there's a very common mistake I see lots and lots of advisors make that ends up costing their clients thousands. Follow along as I show you what that mistake is and what you can do to avoid it. Now, this mistake that we're going to talk about today, I've seen many advisors make it. I don't want to pick on anyone in particular, but I am going to pull up a blog post by Vanguard. And I'm going to show you how even Vanguard here, I believe, gets it wrong. Before I go further, I think Vanguard has done more good for the financial advice industry than any other single company. So this isn't an anti-Vanguard thing as much as it's here to show you how even good-intentioned advisors can ultimately make mistakes that cost their clients. Let's walk through what I mean by this. So this post by Vanguard is called Asset Location Can Lead to Lower Taxes. Here's how to get more value. Now I'll show you where this is right, but then where it starts going wrong. So let's scroll through here. As we walk through this, just to highlight this, what Vanguard correctly points out is that not all kinds of investment income are taxed the same way. So they'll talk about long-term capital gains. If you have an investment that you purchase that appreciates in value, as you can see here, the long-term capital gain tax bracket is 15 to 20% at the federal level, plus potentially some surcharges if your income's over a certain level. So that's a tax-preferred rate, because if you look at ordinary income rates, earnings from bonds, earnings from interest, earnings from things that are non-qualified dividends or short-term capital gains, those are taxed at up to 37% plus the same surcharges if your income's over a certain level. So right off the bat, you can see, okay, not all investments are created equal, not just in terms of their returns, but in terms of how they're taxed. So Vanguard continues. They walk through this, and I'm not going to read through everything, but I am going to show you just the highlighted portion here. What Vanguard says, and what many advisors say, is, okay, let's look at this. Bonds are not taxed at a favorable rate. Interest from bonds, assuming it's not like a treasury bill or a municipal bond, but just a standard corporate bond or something like it, that interest is fully subject to ordinary income rates, both at the federal level, and then depending on the state you live at, maybe the state level as well. So that income is taxed up to 37%. Versus if you have a stock, and that stock appreciates, well, the appreciation on that, if you wait for at least 1 year to sell it, or the qualified dividend from that if you've met the holding period requirements, it's taxed anywhere from 0 to 15 to 20%, plus any potential surcharges. So what does Vanguard say? What do many advisors say? They say, hey, look at this. If you're going to own a portfolio, and in this example, Vanguard's using a portfolio, a hypothetical portfolio of half stocks, half bonds, they say place all the bond investments in a traditional account first. So call this your traditional IRA or your 401k. Second, place any remaining bonds or overflow into a Roth account. Now, I'm going to come back to this later, but that's its own issue. I don't see any reason to place excess bonds in a Roth IRA. Your Roth IRA is going to grow forever. And the tax benefits of putting money into a Roth IRA don't happen during the contribution, they happen with a long-term growth. So why would we try to minimize the growth on a completely tax-free account? There's sometimes reasons, but they have to do more with your risk tolerance and your comfort level, not really an asset location thing. So cutting to the chase a little bit, this is an example, in my opinion, of very short-term thinking, or very short-sighted thinking of how can we do or what can we do to minimize taxes this year, but it misses the bigger picture of what's that thing costing you in terms of years and years and years of superior tax-free growth, or at least the potential for superior tax-free growth if you're getting the returns that stocks have historically offered over time. So more on that later. Then finally, then you fill the taxable account. So this would be an individual account, a joint account, a trust account, anything that's not sheltered from taxes like an IRA or Roth IRA. Then you fill the taxable account with any remaining space in the Roth account with stock investments. So why is Vanguard saying this? Why do many advisors say this? Well, they're right to a degree. They're right from the standpoint of, hey, all those bonds that were generating interest that's subject to ordinary income tax rates, now that interest isn't taxable. Either it's deferred because it's in an IRA, or it's tax-free because it's in a Roth IRA. So that tax rate of up to 37%, you don't have to worry about it. Then any long-term gains or qualified dividends that you do have, well, at least those are in your brokerage account where they're taxed at a maximum of 15 to 20% plus any potential surcharges at the federal level. So again, they're right here, but there's two main problems. The first is what I just showed you. I cannot see for the life of me why you would want to prioritize bonds in a Roth account unless you're so short-sighted that you're willing to miss out on the long-term growth potential in your Roth IRA, all for the sake of earning a little bit more after taxes this year. So this begs the question, how much after taxes are you earning by doing this? Well, Vanguard answers that. They go through this and say, our research shows that the following asset location principles can boost returns between 0.05% and 0.3% a year. Now that's not insignificant. My bigger concern with it is what's it then potentially costing you on the flip side. None of this can be looked at in a vacuum. We have to look at the potential savings here as well as the potential downsides. One potential downside, as I already said, is you're missing out on a lot of years of superior potential growth by having stocks in your Roth IRA as opposed to bonds. The second risk, and maybe even the bigger risk that I see, and this is really the point that I want to get across, is this does not take into account the impact of a market downturn in retirement when it comes to the sequence in which you're going to withdraw accounts. So before I dig deeper into this, I want to come back to this here. This strategy, which again, I fully agree with in principle, it can boost returns. This is proven between 0.05% and 0.3% per year. What's the difference? Well, the higher your income tax bracket, the more you're going to save by this. The lower your income tax bracket, the less beneficial this is going to be for you. Generally speaking, when people are in retirement, they're in lower income tax brackets than they are in their working years. So maybe in your working years, depending upon your income, maybe this is closer to the 0.2, 0.3% range. I'm just speaking in generalities here. During your working years, maybe that 0.2 to 0.3% savings. In your retirement years, it's probably between that 0.05% and maybe 0.15%. Let's call it a 0.1% annual savings. So not insignificant, but hold that in your head real quick. And I'm asking you to hold that in your head real quick because I now want to compare it to what this could potentially cost you. So 0.1% potential savings. Let's now go to the example Vanguard uses. They say in this example, the initial $1 million portfolio, so in this hypothetical that they're running, we're assuming $400,000 in tax deferred. So in other words, $400,000 in a traditional IRA, $200,000 in a tax-free account, so $200,000 in a Roth IRA, and $400,000 in a taxable account. So that's what the asset location principles are looking at. And what they would do is they would say the entirety of this $400,000 IRA would be all bonds. The Roth IRA with $200,000, that would be 50% bonds, 50% stocks. Because of a $1 million portfolio, 500,000 of it is bonds, 400 went in the IRA, the remaining 100,000 would go in the Roth IRA, and then 100,000 of stocks in the Roth IRA and 100,000 of stocks in the taxable account. Okay, so I think you get the picture of what Vanguard is showing in terms of the breakdown of the accounts and how assets are invested. Here's the problem. Many people in retirement, the goal is to draw down that taxable account first. When you're spending money, ideally you're spending on the taxable account first because that allows for continued growth in your Roth IRA and opens up the door for things like Roth conversions, tax gain harvesting, potentially qualifying for health insurance subsidies, all those different benefits. If you are doing that, and 100% of your portfolio is in stocks, here's a challenge. This is just a chart from JP Morgan that says since 1950 until the end of last year, here's the range of returns you can expect from your stock investments, specifically looking at the S&P 500. So this is the range of returns. There's been a calendar year return as high as 52% positive return, a calendar year return as low as negative 37%. On average, bear markets happen 1 in 5 years. On average, let's say the downturns 20 to 25%. So 1 every 5 years or so, your portfolio might be down 20 to 25%. Well, if you're drawing your brokerage account and the entirety of your brokerage account is in stocks, well, what happens when those stocks are down 20, 25%? Well, you either throw your entire withdrawal strategy out the window or you are forced to sell stocks at a 20 to 25% loss. So this is starting to phrase the issue here. There's a potential 0.1% or so gain for asset location over time, and the principles applied with that. But the potential loss, in my opinion, is significantly greater there. Now, you're not having to sell the entirety of your brokerage account down 20 to 25%, but if you have 400,000, like you did in this Vanguard example, and you're taking, say, 35 to 40,000 out per year, that's 10% of your account. You're having to liquidate 10% of your account at a 20 to 25% downturn, and what you've effectively done is you've shot yourself in the foot all to save 0.1, 0.15% or so per year long term from these asset location principles. So if we go back to this, if we knew for certain the stock market was only going to go up every year, well, this is a good approach. I still don't like the fact that the bonds are in the Roth IRA. And in fact, if we knew the stock market was only going to go up, there's really no reason for bonds. But we don't know the stock market's only going to go up, which is why we have some bonds. And because we don't know that the stock market's only going to go up, if we don't have any bonds, any stable assets in our portfolio or in the part of our portfolio for example, the taxable account, to draw from when the market drops, I don't care that we're saving a little bit in taxes long-term by having this asset location strategy. It's costing us significantly more by forcing us to sell in a downturn and liquidate some of those great stock investments that we have. So like I said here, this isn't to pick on Vanguard. This isn't to pick on other advisors. What I am saying though is you need to be hyper vigilant in terms of how you're receiving and implementing this advice, because there is the very real possibility that a strategy on paper in vacuum works. But if you're not careful, you may not understand how that strategy negatively impacts you in other aspects of your financial plan. So what are the principles that we can take away from this? Number one is asset location does work. So the principles, the hypothetical, the research here, it's absolutely true. What I will say is it tends to be more beneficial in your working years. Why is that? Well, it's because in your working years, you're most likely going to be in a higher income tax bracket, and therefore the savings, the tax savings from proper asset location principles will be superior. Now, the flip side of that is in your working years, you probably don't have as much in bonds in your portfolio. So they used a 50-50 portfolio, Vanguard did in this study. Well, who has 50% bonds in their portfolio in their working years? Certainly some people, but I would say at least the majority of people I see probably don't. This is not a recommendation, and I'll be very clear about that, but the majority of people I see do not have 50% bonds in their portfolio in their working years. And the less you have in bonds, the less these asset location principles will actually benefit you, because you're not getting the benefit of having that taxable interest in a tax-free or tax-deferred account. The second principle here is that sometimes financial planning is about balancing conflicting priorities. So yes, we want to save taxes year by year. That's a lot about what asset location is. However, it is very possible to get too short-sighted into that and say, look, we're saving taxes, wonderful, but missing the bigger picture, or missing the competing strategy that would be even more beneficial to us long-term. So how do you understand what strategies exist, what opportunities exist, and then how do you prioritize those? Sometimes one coming at the expense of the other. Then finally, the third principle is you always have to take that long-term view. Not just talking about the stock market here, but with asset location, as I mentioned, it's very possible to get so short-sighted and say, look at this, we're saving 0.1%, 0.2% this year. That's great. But at what cost long-term? How much less tax-free growth are we now expected to have in our Roth IRA because we filled it up with bonds, for example, as opposed to stocks, which will continue to drive that tax-free growth going forward. So as you look at this, this is where financial planning is part art, part science. Yes, there are some hard and fast rules, some things that you should absolutely apply, but sometimes you have to know how to look at it. And sometimes not every strategy is going to fit perfectly with others. So make sure you're careful as you're going through that. So this video ultimately highlights a mistake that many people make in retirement, and unfortunately, oftentimes at the recommendation of their advisor. This isn't the only mistake I see people make. In fact, I made this other video here where I walk through 3 very common tax mistakes people make in retirement. Watch that video so you can understand what those mistakes are and what you can do to avoid them. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.